Preparing for a financial analyst at Con Edison interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Con Edison? I am attracted to Con Edison because the analyst role combines rigorous finance with essential infrastructure. Reliable electricity and gas require thoughtful forecasting, capital allocation, cost control, and regulatory awareness. My strengths in Excel, variance analysis, and communicating financial insights would help decision-makers understand performance and risks. I also value the company's long-term focus on reliability and clean energy investment. Con Edison offers an opportunity to build strong finance skills while contributing to services customers depend on every day. While answering, connect your analytical skills to Con Edison's regulated utility model, infrastructure investment, reliability mission, sustainability priorities, and the opportunity to support disciplined decisions with meaningful public impact. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet and begins the operating section of the cash flow statement. The balance sheet presents assets, liabilities, and equity at a specific date. Cash flow adjusts earnings for non-cash items such as depreciation and changes in working capital, then includes investing and financing activities. For a utility, capital expenditures and depreciation are especially important links among all 3 statements. Make sure to cover the income statement, balance sheet, and cash flow statement, explaining net income, retained earnings, depreciation, working capital, capital expenditures, and the importance of reconciliation. Question 3. How would you analyze Con Edison's revenue performance? I would decompose revenue into customer volume, usage, approved rates, weather, and other non-recurring items. For Con Edison, electricity and gas demand can change with temperature, while regulated rates and mechanisms may recover certain costs separately. I would compare actual results with budget and prior year, quantify each driver, and investigate unusual movements. I would also distinguish revenue growth from pass-through costs, because higher reported revenue does not automatically indicate stronger profitability or cash generation. In your answer, talk about volume, customer count, rates, weather, fuel costs, regulatory recovery, product mix, period comparisons, and separating sustainable operating trends from temporary drivers. Question 4. What is a regulated utility rate base, and why does it matter? Rate base generally represents the utility investment eligible for recovery through customer rates, often including qualifying plant, working capital, and related adjustments, net of accumulated depreciation. Regulators determine which investments are prudent and the return the utility may earn. Rate base matters because approved growth can support revenue and earnings, but it also affects customer bills. I would analyze whether capital spending improves reliability or compliance and whether recovery timing matches the investment plan. Be sure to mention net utility assets, prudently incurred investment, authorized returns, depreciation, regulatory approval, customer rates, and why rate base growth must remain aligned with affordability and service needs. Question 5. How would you investigate an unfavorable operating expense variance? I would first validate the data and compare actual expense with budget, forecast, and prior periods. Then I would break the variance into price, volume, timing, headcount, project mix, and accounting classification. I would review supporting detail, accruals, purchase orders, and explanations from the responsible operating team. Finally, I would determine whether the issue is one-time or recurring, update the forecast if needed, and recommend a specific action rather than simply reporting the unfavorable percentage. Focus on confirming the variance, separating price, volume, timing, and mix effects, reviewing actual invoices and accruals, consulting business owners, identifying controllable items, and recommending corrective action. Question 6. Describe your approach to building a financial forecast. I begin with historical actuals, but I do not extrapolate blindly. I identify operational drivers such as customer demand, labor, commodity prices, capital projects, rates, and timing. I build assumptions transparently, validate them with business partners, and create base, upside, and downside cases where uncertainty is material. After publishing the forecast, I compare actual results with assumptions, explain variances, and refine the model. Good forecasting is a repeatable feedback process, not a one-time spreadsheet exercise. Make sure to cover historical trends, operational drivers, assumptions, business owner input, scenario analysis, model integrity, variance tracking, and clearly documenting changes from the prior forecast. Question 7. How would you evaluate a major capital project for Con Edison? I would evaluate both financial returns and the project's service obligation. First, I would confirm the need, expected reliability or compliance benefit, scope, timing, and total cost. I would then model incremental cash flows, including construction spending, operating savings, depreciation, financing, and potential regulatory recovery. NPV, sensitivity analysis, and contingency assumptions would show economic resilience. I would also assess execution risks, permitting, supply constraints, and whether delays could affect reliability, customer rates, or the broader capital plan. In your answer, discuss strategic need, reliability, safety, regulatory compliance, construction timing, cost estimates, NPV, funding, rate recovery, execution risk, and sensitivity to delays or overruns. Question 8. What is the difference between capital expenditures and operating expenses? Capital expenditures purchase, construct, or materially improve assets that provide benefits over multiple periods. They are recorded on the balance sheet and expensed through depreciation over their useful lives. Operating expenses support current operations, such as maintenance, payroll, or administrative activities, and generally reduce earnings immediately. The distinction affects reported profit, cash flow classification, rate recovery, and asset balances. I would apply accounting policy consistently and avoid capitalizing routine repairs simply to improve short-term earnings. Be sure to explain that capital expenditures create or improve long-lived assets, while operating expenses support current operations, and discuss capitalization, depreciation, earnings timing, cash flow, and policy compliance. Question 9. How do interest rates affect a utility like Con Edison? Higher rates can increase interest expense when debt is refinanced and raise the cost of funding large infrastructure programs. They can also pressure valuation because investors discount future cash flows more heavily. For a regulated utility, approved recovery mechanisms and allowed returns may eventually address some cost changes, but timing matters. I would monitor maturity schedules, fixed versus floating debt, interest coverage, financing assumptions, and the potential effect on capital affordability and customer bills. Focus on debt refinancing, interest expense, project financing, valuation, allowed returns, customer affordability, credit metrics, and the timing difference between higher financing costs and regulatory recovery. Question 10. Explain how you would calculate and interpret free cash flow. A common calculation is operating cash flow minus capital expenditures. It measures cash remaining after funding the asset investment required to operate and grow the business. For Con Edison, the interpretation requires context because substantial infrastructure spending can depress free cash flow even while long-term regulated earnings potential improves. I would distinguish maintenance, reliability, and growth projects, review working capital and regulatory timing, and consider whether funding comes from debt, equity, or internally generated cash. Mention operating cash flow, capital expenditures, free cash flow definition, maintenance versus growth investment, regulatory timing, financing needs, dividends, and why accounting earnings may differ materially. Question 11. What is the difference between regulated and unregulated utility earnings? Regulated earnings are generally shaped by approved rates, authorized returns, and recoverable costs, creating greater visibility but also exposure to regulatory decisions and timing. Unregulated earnings depend more directly on market prices, customer demand, and competitive conditions, so they can be more volatile. I would analyze each segment separately, avoid applying one margin assumption across the company, and identify regulatory lag, commodity exposure, and market sensitivity before consolidating the forecast. In your answer, compare approved rate recovery and allowed returns with market-based pricing. Explain earnings volatility, regulatory lag, competitive exposure, and how segment mix affects forecasting and risk. Question 12. Tell me about a time you identified an error in financial data. In a prior analysis, I noticed that monthly expense growth did not match the underlying activity level. I reconciled the general ledger to the detailed schedule and found that one invoice had been recorded twice after a manual upload. I documented the evidence, informed my manager, and worked with accounting to reverse the duplicate entry. I then added a control comparing invoice numbers and totals before submission. The experience reinforced that analytical skepticism and simple reconciliations can prevent larger reporting problems. Make sure to present a clear situation, explain the analytical procedure that exposed the issue, quantify the impact, describe escalation and correction, and emphasize prevention through controls or documentation. Question 13. Which Excel tools would you use in a financial analyst role? I regularly use SumIfs, XLOOKUP, index match, pivot tables, charts, and conditional formatting to analyze and present financial data. For larger recurring files, Power Query can improve consistency and reduce manual manipulation. I structure models with separate inputs, calculations, outputs, and clearly labeled assumptions. I also include reasonableness checks, balance checks, and variance flags. The objective is not using the most complicated formula, it is creating a reliable model another analyst can understand and update. Talk about SumIfs, XLOOKUP, index match, pivot tables, charts, scenario analysis, data validation, error checks, Power Query if relevant, and keeping models transparent and auditable. Question 14. How would you analyze the financial impact of a severe storm? I would first estimate immediate restoration costs, including overtime, contractors, materials, transportation, and damaged equipment. I would separately assess lost revenue, customer service impacts, insurance proceeds, and potential regulatory recovery. Because timing is uncertain, I would build scenarios based on outage duration, damage severity, and restoration speed. I would then evaluate cash needs, accounting treatment, and forecast effects, clearly distinguishing one-time storm costs from recurring resilience investments. Communication should be frequent, factual, and updated as information improves. Focus on emergency restoration costs, lost revenue, overtime, inventory, insurance, regulatory recovery, cash timing, customer impacts, scenario ranges, and distinguishing immediate effects from long-term infrastructure consequences. Question 15. How does the energy transition affect Con Edison's financial analysis? The energy transition creates both investment needs and analytical uncertainty. Electrification, distributed generation, storage, and grid modernization may require significant capital, while changing demand patterns can affect utilization and revenue. I would model project economics, regulatory treatment, construction timing, operating savings, emissions benefits, and potential asset stranding risks. I would also test customer affordability and policy scenarios. Strong analysis should show how sustainability initiatives support reliability and long-term value, rather than treating environmental goals and financial discipline as separate priorities. Be sure to mention renewable integration, electrification, grid modernization, distributed energy resources, regulatory requirements, capital intensity, customer demand, stranded asset risk, and balancing sustainability with affordability. Question 16. What financial controls are important in a utility environment? Important controls include segregation of duties, authorized purchase approvals, accurate vendor setup, three-way invoice matching, and timely account reconciliations. Capital projects also require documented approval, appropriate capitalization decisions, asset records, and review of costs against budgets. Access controls and change logs protect financial systems, while regulatory reporting requires strong supporting evidence. I would test controls based on risk, investigate exceptions promptly, and document remediation. Effective controls protect reporting integrity without unnecessarily slowing essential operations. In your answer, cover segregation of duties, approval limits, purchase-to-pay controls, capitalization policies, reconciliations, access management, regulatory documentation, audit trails, and timely remediation of exceptions. Question 17. How would you assess working capital at Con Edison? I would examine receivables, payables, inventory, accrued expenses, and customer-related balances against historical patterns and operational drivers. Seasonality, billing cycles, commodity costs, storm inventories, and collection trends can all create significant movements. I would calculate days metrics where useful, investigate unusual aging or accrual changes, and separate temporary timing from structural deterioration. The goal is understanding cash consequences while preserving service reliability and avoiding actions that could harm customers, suppliers, or emergency readiness. Focus on accounts receivable, accounts payable, inventory, accrued expenses, customer collections, seasonal demand, storm materials, cash conversion, and the difference between operational and regulatory timing effects. Question 18. How would you present an unfavorable forecast change to senior management? I would lead with the revised outlook and quantify the change against the prior forecast, budget, and key performance measures. Next, I would explain the main drivers, separating controllable issues from external factors such as weather, rates, or commodity prices. I would state the confidence level and identify the assumptions most likely to change. Finally, I would recommend actions, owners, and timing. Senior management needs a concise decision-oriented message, supported by detail available for follow-up. Make sure to lead with the conclusion, quantify the impact, explain root causes and confidence levels, distinguish controllable from external factors, provide actions, and tailor detail to the audience. Question 19. What financial risks would you monitor at Con Edison? I would monitor regulatory lag, rate case outcomes, financing costs, liquidity, construction overruns, severe weather, cybersecurity, commodity exposure, and environmental compliance. I would translate each risk into potential effects on earnings, cash flow, credit metrics, capital plans, or customer rates. Leading indicators might include project milestones, contractor performance, debt maturities, receivable aging, and storm forecasts. I would maintain a risk register with owners, probabilities, financial ranges, and mitigation actions, rather than treating risk as a static checklist. Discuss interest rates, regulatory decisions, construction overruns, weather, cybersecurity, commodity exposure, credit, liquidity, environmental compliance, workforce capacity, and the use of leading indicators. Question 20. Describe a time you had to explain a complex financial issue to a non-finance audience. During a budgeting project, an operations manager questioned why a favorable expense variance did not improve cash flow. I explained that the variance reflected an accrual timing issue, not a permanent reduction in spending, and used a simple timeline showing when the invoice would be paid. I avoided accounting jargon, confirmed the manager's understanding, and followed up with a concise reconciliation. The discussion improved the forecast and helped the team distinguish reported earnings from actual cash movement. While answering, emphasize audience awareness, simple language, visual support, linking financial metrics to operational consequences, checking understanding, and adapting the explanation without losing accuracy. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.